Peter joins us all the way from Australia. And that's what the attempt is. We're trying to get you as many...
The entire globe.
Cover the entire globe. Yep. We need to... That, it's so much global in nature that one side you could say, if Fed increases rates, it's actually good news because that means Fed believes that the banking system is stable. Banking system can absorb that shock. If Fed is not going to increase rates, that means that the Fed is scared that, oh my God, the system is breaking down and the system is not able to digest any more rate hike. So really, depending on whom you want to argue, what you want to argue, what your positions are, you will get a different kind of an answer. Commodity prices coming down.
The markets would be happy though if Fed pauses.
Yeah, markets would be happy if Fed increases rates. See, the collateral damage by 25 bips rate hike is not going to be large in terms of the demand and other factors. For 4 becoming 4.25 or 3 becoming 3.25, the collateral damage is not large. But the signaling that the Fed has got everything under control, I think is far more important. See, what is the worry in the world? The worry in the world is not demand or recession or inflation. It is about the systemic collapse. That is something which only the regulator can endorse. I mean, only the regulator can come out and say that the fear of one bank going belly up, second bank, not going belly up, that the regulator has to come out and say.
How things have changed. A week back, we would have said that, yeah, Fed is going to be, or other markets are going to be happy if the Fed pauses, but now things are completely different.
Peter, good morning.
Morning, Naraj.
How are we doing this morning?
We're doing pretty good, thank you. It's sitting here, and I'll tell you what, there's no shortage of opportunities, Nakaj, in not only the commodity complex, but the currencies have been incredibly volatile over the last 24 hours.
Peter, the sequence of events is quite reminiscent of, let's say, what we saw almost 7-8 years ago when we were talking about collapse of European economies. We're talking about Greece, Portugal, Italy, Spain. We're talking about banks blowing up now. So do you think this is just the tip of the iceberg? Rather than looking for opportunity, it is important to run for cover, hide for shelter?
Well, whether it's the tip of the iceberg, it's certainly from a global contagion mindset. The Credit Suisse situation is very worrying, and whether this could wrap itself around European banks. So as we sit here at $2, I'm looking here, it was down 24% for Wednesday, and you're looking at a 50 billion rescue package from Swiss, that's in Swiss francs, from the Swiss National Bank. So I sit here and I hope that that's enough support to re-engage Credit Suisse, but it's just a wait and see proposition, and how that rolls across to decisions from Fed Chair Powell, from central banks moving forward with rate either hikes or putting the foot to, taking the foot off the accelerator. These are all unknown and uncharted territory. But there's a lot of similarities, as you said, going back 8 years or so. And in some ways, it's possibly going to be similar to 8 and 9.
Peter, is there a major now worry in the markets that we could see this contagion effect spilling over to the overall global banking system?
Yes, I think so. I think from what I read and what I take on board, yes. And I think that would be... political, so the politicians, that would be significantly a great concern to the likes of the SEC, to the likes of ASIC, to the likes of the regulatory bodies out there, what's going on, and looking at, this is an hour-by-hour proposition. You don't like seeing the start or the mindset that banks are in a weakened position. So yes, you've got to stem that, you've got to soften that, and you've got to make sure that there's confidence across the retail sector and, of course, from the commercial arms of banking. And all of those, that sentiment needs to be really a top-down approach from not only regulators but politicians saying that everything's okay. And I think that's where we're at the moment.
What about the outlook now in terms of how investors will really approach this? Do you think there's going to be now a force or a race towards safe havens like treasuries? What's going to be the view in terms of the expectation that the market will be pleased with from the US Fed Reserve? As we were saying, perhaps a mild hike would be the preferable option.
Well, Nakunja's argument, just as he was introducing me, yes, I do take that on board. That maybe, you know, I don't think 25 basis points is going to really impact the psychology of the market too greatly, for as far as the Fed was concerned. So that might be a thought there, and what that does naturally to the US dollar, and where does, you know, the likes of indexes, what happens to Wall Street and the overall picture globally with equity markets. And naturally, you roll that across to bond yields, currencies, commodities. Look at copper yesterday, down nearly 4%. Gold still sitting at that 1915 sort of handle. I'm looking on the screen now, yeah, about 1915. So, yeah, there's big moves out there, big volatile moves, and that's a good thing if you're a trader. But yeah, I don't know if central banks like it.
We can keep guessing that. Hopefully things are going to disclose soon. Peter, great to have you on the show. Thanks as always for taking the time out. Let's just see what